Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel at the rate Accounting Buddy NB. In today's lesson, we will learn meaning and practical application of sales and revenue, including sales return, along with a clear explanation of purchases and purchase returns using real life examples. The lesson also covers the concept of goods, helping you understand what actually flow through a business. We then move to inventory, including opening and closing stock concepts and type of inventories, that is raw material, work in progress and finished goods, explained in a simple and relatable way. Further, we break down receipts into capital and revenue receipts and expenditure also into capital and revenue, along with the classification of business costs into fixed, variable and semi-variable expenses. Finally, we explain the concept of accounting period and conclude with a practical question and answer session to reinforce your understanding. So sit back, relax and watch the full video till the end. Let us now learn the term sales. Sales is an activity which involves selling of goods or services for monetary consideration. Consideration is either paid immediately or is promised to be paid at a future date. If the consideration is paid immediately in exchange of goods or services, it is called cash sales. While if the consideration is promised to be paid at a future date, even if the goods are delivered to the customers, it is called as credit sales. The term revenue is also referred to as sales in the financial statements. Let us now understand credit sales and cash sales with an example. For instance, Mr. X sold stationery worth INR 500 to a customer and the customer paid cash and collected the stationery. This is an example of cash sales for Mr. X. Now in another scenario, if Mr. X has sold stationery worth INR 500 to another customer and that customer has promised to pay for it after 30 days but took the delivery of the stationery, it is an example of credit sales for Mr. X. Now let us learn another term, sales return. Goods once sold to a customer, if they are returned for any reason, they are termed as sales return. Sales return could be either in full or in part. Let us have an example of sales return. If the total sales of the business is INR 10 million and the customer has returned goods worth INR 75,500, sales net of return, that is INR 9,924,500, will be shown in the P&L of the business. Term number 9 which we are going to learn now is the term purchase. Purchase refers to the activities involved in buying the goods either for resale or for producing or processing finished goods which are meant to be sold. Now the goods purchased for cash are treated as cash purchases and the goods purchased now with a promise to pay at a future date is called the credit purchases. For example, if 100 quantity of ready-made shirts are bought for INR 20,000 for resale, it is a purchase transaction. Similarly, if 250 meters of cloth is bought to stitch the shirts which are meant to be sold by the business is again an example of purchase transaction. Let us now understand the term purchase return. Goods once purchased when returned to the supplier for bad quality or for any other reason are termed as purchase return or return outward. Purchase return could be either in full or in part. For example, a business has bought goods for INR half a million and due to bad quality they returned the goods worth INR 175,000 to the supplier. Therefore, the net purchases of 4,825,000 will be reported in the financial records of the business. Item number 10 which we will learn is the term goods. Goods are the physical items which are meant for resale. Goods are physically available with the business as stock in hand. These goods are either purchased or manufactured with a purpose to sell. The purpose for which a physical item has been held will determine whether it is classified as goods or a fixed asset for a business. Let us understand this point with an example. In case of a car dealer who deals with the selling of cars, the number of cars in his showroom are goods for his business, while the same car, if owned by a business which is engaged in the passenger transportation business, it will be treated as a fixed asset. It is a fixed asset for such business because number one, it is not meant for resale, and second, it is used to help the business operations and generate revenue. To sum up, a car is a good for a business which hold cars as stock to resell them, while a car is a fixed asset for the business which offers cars for hourly, weekly or monthly rental, and these cars are not meant for resale. Accounting term number 11, which we will learn now, is stock or inventory. Stock is a tangible current asset held by the business either to resell or to use it for the production of finished goods which are meant for sale. Four words are very important in the definition of stock. Number one, tangible current assets. Stock has physical existence and is meant to be sold or to be used for manufacturing finished goods within a period of 1 year. That is, it is tangible and it is a current asset. Number two, stock is always held either to resell or to be used for the production of finished goods. Number four, inventory is held, sold or used in the production as the main business activity and not one of business transactions. Let us understand stock further with an example. Mr. X, who runs a flour mill, both wheat and flour are stock. Both wheat and flour have physical existence. Wheat is held to produce flour and flour is meant to be resold. Wheat and flour are expected to be converted into cash within a period of 1 year, that is, they are current assets. Basis above facts, it is concluded that the unsold wheat and the flour is business stock or inventory. Opening stock and closing stock are frequently used business terms. Value of stock on hand on the first date of an accounting year is called the opening stock, and the value of the stock at the last day of the accounting year is called the closing stock. I hope we remember the word accounting year we learned in chapter 1. Another important fact to remember is that the opening stock of an accounting year is the closing stock at the end of the previous accounting year. Let us understand this with an example. Now, if the accounting year is from 1st January to 31st December and the value of the closing stock on the last day, that is 31st of December of the accounting year 2023 is say INR 100,000, and the same INR 100,000 will be the opening stock of the first day, that is 1st January of the next accounting year, that is 2024. Stock can be classified into three categories: finished goods stock, raw material stock, work in progress stock. Let us now discuss these inventory types in detail. Finished goods stock means the value of unsold stock of the goods which are ready for sale. In case of a manufacturing business, it means the stock of goods which is manufactured or processed and is ready for sale. Finished goods are valued at cost or net realizable value, whichever is less. Before we proceed further, let us understand the term cost of finished goods. Finished goods are valued by adding all the costs incurred in manufacturing the goods to its raw material cost. At this stage, it is important for us to understand the meaning of cost or net realizable value.
Now, if the cost of a finished good as explained is say INR 150, while it is expected not to be sold for more than INR 125, the unsold stock of such item shall be valued at INR 125 and not at INR 150. If expected sale price is more than 150, it will be valued at INR 150. Example for finished good in case of a garment business is the unsold stock of shirts. Let us now discuss raw material stock. Raw material stock comprises of unused stock of input raw material meant to be used for manufacturing or processing of finished goods. For a garment manufacturing business, the unused stock of fabric, threads, buttons, zips, etc. is a raw material stock. It is valued at cost or net realizable value, whichever is less. Cost of a raw material means the price paid to the supplier plus all the costs incurred in bringing the raw material to the place of business. Now, work in progress inventory comprises of stock which is neither raw material nor finished product. It is a stock in some middle stage of manufacturing process. The stock of unfinished shirts in case of a garment manufacturing business is an example of work in progress stock. Work in progress stock is valued by adding all the manufacturing costs incurred to its raw material cost. Stock is shown in the balance sheet under the head current assets. Accounting term number 13 which we are going to learn now is the term receipts. The term receipts refers to the actual amount received by the business either in cash or in the bank account of the business for selling of goods or services or even fixed assets. Receipts also include the amounts received from the customers at a future date when the goods or the services are sold on credit. An amount of advance received from the customer is also a receipt. Now, receipt can be of two types, revenue receipts and capital receipts. Let us discuss revenue receipts and capital receipts with an example. Revenue receipts means an amount received in the normal course of the business against the sale of goods or rendering of services or on account of any other business related activity. For example, a garment business sold 100 shirts to a shopkeeper and received INR 20,000. Now this INR 20,000 received by the business is a revenue receipt for the business. Similarly, the interest received from the bank on the fixed deposit is also a revenue receipt for the business. Capital receipt means an amount received against a business transaction which is not revenue in nature. For example, a garment business has sold a delivery van which is a fixed asset for INR 50,000. Now this INR 50,000 is considered as a capital receipt for the business. The next accounting term which we are going to learn now is the term expenditure. Expenditure is the amount of money spent either in cash or on credit for the purpose of running the business. The expenditure could be in the form of buying of goods or acquiring of assets or any other expenditure incurred by the business to generate revenue. To sum up, the business expenditure is an expenditure on buying of goods or buying of services or buying of assets for business or any other expense incurred for business to earn profit. This expenditure can be either in cash or in credit. Business expenditure can be of two types, capital expenditure and revenue expenditure. Capital expenditure means long-term business expenditure incurred to acquire new assets or upgrade existing assets of the business. Capital expenditure are incurred with the purpose of enhancing the earning capacity of the business. Capital expenditure may result into acquiring a tangible or an intangible asset. Benefit of capital expenditure is realized by the business over several years. Capital expenditure are recorded as fixed assets and are shown on the asset side of the balance sheet. Examples of capital expenditure are purchase of plant and machinery, or acquiring land and building, or upgrading existing assets of the business. Now, revenue expenditure are the day-to-day expenses which are necessary for running the business and managing business operations. Revenue expenditures has a direct relationship with the revenue generated during a period. The benefit of revenue expenditure is consumed by the business within a reporting period. Revenue expenditure are recurring in nature. They are incurred regularly. Revenue expenditures are charged to the profit and loss account and deducted from the business revenue to calculate the business profit or loss. Staff salary and wages, rent, electricity expenses are few examples for revenue expenditure. Business expenditure can be classified into fixed cost, variable cost, and semi-variable cost. The cost that remains constant regardless of the level of sales or production are called fixed costs. Examples of fixed cost are rent, insurance, and management salary. Variable costs vary directly with the level of production or sales. Example of variable cost are raw material cost, direct labor cost. Semi-variable costs are neither fixed nor variable. A portion of it is fixed and a portion is variable. Electricity expenses is an example of semi-variable cost, as part of it is fixed base charge and part of it is variable basis electricity used. Another example could be sales staff's cost. They get fixed salary plus variable amount of commission basis sales generated by them. 15th accounting term which we are going to learn now is the term accounting period. Accounting period is a span of 12 months for which the financial performance and the financial position of the business is reported in the form of financial statements. And we know the financial statements are profit and loss account, balance sheet, and cash flow. Accounting period of 12 months is also known as financial year or fiscal year. Accounting period of 12 months can be Jan to December or June to July. In India, accounting period is from April to March. Let us understand this with an example. If accounting period starts from 1st of April 2023 and ends on 31st March 2024, it will be read as financial year 2023-24 or FY 2023-24. In this case, an accounting year which starts on 1st of April and ends on 31st March 2024 falls under two calendar years, that is 2023 and 2024. Let us now answer few questions related to our learnings of chapter 2 part 2. Question number 1, give 3 examples of revenue expenditure. The answer is staff salary, electricity expenses and office rent. Question number 2, give 2 examples of current assets. Cash in hand and trade receivables are current assets. Question number 3, define the term goods. Goods are the physical items which are either meant for sale or are meant to be used in the manufacturing of the finished goods which are meant for sale. Question number 4, what are the main classes of liabilities? Current liabilities and non-current liabilities are the classes of liabilities. Question number 5, finished good inventory is valued at cost, true or false? This is a false statement. It is valued at cost or net realizable value, whichever is less. Question number 6, define variable cost. Variable cost varies with the level of business activity of sales or production. Question number 7, sales is always shown net of sales return, true or false? This statement is true.
In my next video on 9th of May, you will learn practical meaning of prepaid expenses, accrued expenses, along with their accounting treatment using easy to follow examples. We will explain the concept of income and operating activities, and lesson will also break down profit, including gross profit and net profit, with simple illustration to build strong clarity. You will also understand key working terms like trade receivables, trade payables, debtors, creditors, and cost. We further cover the importance of discounts in business, clearly distinguishing between the cash discount and the trade discount. Essential terms such as vouchers, business entity, sole trader, along with core concepts of debit and credit is also explained. Finally, we give a brief about clear understanding of profit and loss account, balance sheet, and cash flow statements, and the concept of depreciation with examples. If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share, and like my YouTube channel at the rate Accounting Buddy NB. Thank you and goodbye for now.